going. So yeah, I know. Yeah, today's going to be actually a light day. Today, as you guys know, it's Friday. It's the end of the week, and typically we see on most Fridays some profit taking. But for the most part, we're just going to share what we have with us right now as far as day trading opportunities. But I'm not really confident in these setups. But we can still take them. And I think the two positions that we're in right now are two positions that we should definitely be looking for opportunities around. But um, we still don't have total confidence in those because of some things that didn't meet. But for the most part, it's going okay thus far. But anyways, let's move forward. So yeah, good morning, everyone. Good morning, Robert. Good morning, Greg. Good morning, Jesse. Thank you guys so much for coming to today's live trading session. As you guys know, today is Friday the 13th, which is, a day where, has this bad omen associated with it. But for the most part, we're going to trade the way we've been trading, and we're going to hope that the markets go in our favor, which, that's what we're going to look forward to. So with that said, let's move on and let's look at this first pair that we're looking at right now, which is the Swiss franc Japanese yen, or Swiss yen. And we're currently looking at the 1 hour chart. Remember, most of our day trading opportunities happen around the 1 hour chart, but we use other time frames either to understand directionality or to get into our trade or execute our position. But in this case right here, with the way it's looking right now, what will we be looking to do? Will we be looking to buy or sell based on how price is moving right now on the 1 hour chart? What bias would you have based on what you would see on this particular chart? And there's reasons to say a buy or a sell. In all honesty, you can say either or, but based on how price is moving currently on the 1 hour time frame, what side of the market will you stay on? Or what side of the market will you be on? Would you be a buyer or would you be a seller? So I'll give you guys a second to chime in. Okay, yep. Robert said for 1 hour buy, and he's correct. Based on what we're seeing on the 1 hour chart, we'll be looking to buy. As you can see, price, gave us higher highs, higher low, and another higher high right here. So based on what he said, we'll be looking to buy on a dip in price. Look for a pullback and a buy. However, just because you see things look like this on the 1 hour chart doesn't mean other time frames confirm that particular bias to the upside. As you guys can see, historically, we've been in a nice, strong move to the downside. You see this strong move to the downside? So even though we have this nice correction, there could still be momentum to the downside. But what we're going to do is look at a few things to support a reason behind why we may want to look for a buy. So going for starters, what we'll typically do, we'll look for an opportunity to buy on a dip in price, on a pullback. Price made higher highs, higher lows. Also the 20 SMA, which is this blue cyan line right here, is sloping to the upside. So then that tells us that there is some bullish momentum, you could say, to this particular pair. But let's look to see what the other time frames give us as well. So this is the 1 hour. 4 hour is looking bearish, right? 4 hours looking bearish. We had this nice strong move to the downside. Price is in the middle of this correction, which is something that I'm looking at as well. I do believe this move to the downside in this correction could be providing another sell opportunity. So you got to definitely keep that in mind. But 4 hours bearish and the daily chart is bearish. So then oftentimes they keep it safe. The best thing you may want to do is stay on the side of overall directional bias, which is to short or sell. However, there are times where you could risk going long and entering a buy. But if you do that, you definitely want to make sure that your position position size is smaller on that particular setup. You're not going to execute it at a normal position or a normal bet size. You're going to reduce your position so that you can reduce your potential loss if price does go against you. So in this case, is there reasons to go long? Well, for starters, if you look at the daily, we see that price is pretty overextended to the downside. And well, no, this isn't an institutional level, but we do see price testing, for starters. This, is a form of hidden structure right here, hidden support right there. I'll share more details on that later. But if you look left, is there a reason? But we don't have anything to the left of us. But what we can clearly see is that price is definitely overextended to the downside and we're due for a correction to the upside. And if you look at stochastics, it's also oversold. So then that's something to pay attention to as well for this particular pair. Also, we have this orange 100-day moving average, which is acting as dynamic support. So, we have those factors in mind. We have hidden structure, hidden support to the left. We have this 100-day moving average acting as dynamic support. And we have stochastics oversold. So then we could be due for a deeper correction even based off of what we see on a daily. But even what we see on a 4-hour could also hint to a deeper correction, a deeper pullback. So let's just assume that we are going to enter this trade, or we're looking to sell. And if you draw in your Fibonacci, we're right at the 38.2, which is typically where we drop down to our trigger time frame if we're looking to sell. So then that is something to bear in mind. I think at the time I was looking at this earlier, I don't think we were testing this 38.2, but typically price would want to retrace to the 38.2 or somewhere between the 38.2 and 50. But there's still room to push to the upside, but we never know. Price could start rotating lower now. But as you guys know, whenever we do look at pullbacks, we always try to see if there's a 3-wave pullback forming. So then if we are assuming that price could eventually shoot lower, what we can do is see if there is a 3-wave pullback on a smaller time frame on this pullback. If there's a leg A, leg B, and a leg C, that's something that we could check and verify. So then let's do that now. Let's drop down to the 1-hour chart. And do we see something like a 3-wave pullback? Absolutely. We do see something like a leg A and a leg B. Let me just draw this in. Leg A, leg B, and a leg C. So there's a possibility for price to potentially reverse now. So then what I would do in this case, I'm not going to look for a buy like I was before. I'm just going to strictly wait to see what price does. And, we may be able to get in on a sell prior to the week closing. So then that's something that we could potentially do. However, if you're one of those traders that don't like to keep positions open over the weekend, then just forget about trading this particular setup. Just wait maybe until Monday and see if you can get in on a pullback or something like that. But for the most part, what we see right here is this zone of structure. And what you can do is simply wait for price to push to the downside, retrace lower, correct, retest what was once support, becomes resistance, and then we could trade this lower. And if we time our entry right and correctly, we could have a nice solid reward to risk ratio. A little bit lower, maybe to the lows right here. About a 2-to-1 right there if we want to play it more conservatively. But if we're shooting for extended targets, you can definitely target somewhere right above this institutional level at 127. So that'll still give you a nice solid reward to risk ratio. But yeah, that's the Swiss franc Japanese yen, and that's one setup that we're looking at right now. But as you guys can see, we may have to change our bias now to shorting. That's if price breaks through this zone right here. Just wait, break. If it breaks through it, wait for the pullback and then enter your sell. Yeah, just like we've shared before, with you guys, like trading is really just a series of, if then statements where you develop just a set of conditions, or you have this analysis ahead of time that says if price does this, if it breaks above this level, then I'll know to do this, because it will sort of signal and confirm to you what's the what's the right way to approach it, which part of the market, the bulls or the bears, is really gaining traction or really regaining control of the market. So then you want to have these series of if then statements, or plan A, plan B, or plan C when you're trading. So with whatever market condition, or with whatever the market gives you at a particular time, you will know how to trade that particular scenario technically. So then that's how you want to look at your trading. But in this case, like I know Melvin mentioned, I think a few minutes ago, how like if you're reluctant to execute a trade because you feel like there may be some weekend risk, like there could either be some headline news or whatever that may come out over the weekend that may cause spreads to widen and maybe knock you out of the position prematurely, then or even change the bias, because sometimes that happens when you get major headlines breaking over the weekend. Then you see that shift of sentiment, and if you're already in a day trading opportunity, it may not go well for you. You may get stopped out. So then of course, we leave it up to you guys to determine it. Yeah, it is risky holding positions over the weekend, but of course, it's not something that doesn't happen. I mean, we've done it. I mean, you just got to account for what could potentially happen if the spreads do widen and you get shaken out of that position prematurely. But or if over the weekend news comes out that may reverse that particular trade. So then, those are the different risk factors. But trust me, we've done it before. Sometimes it's a decent decision to make, but this is the reason why we use good money management skills, because if price does deviate and change on us, we'll be okay. We risk a certain amount, we'll still live to see another day. We can still close out with profits when it's all said and done. So yeah, this is the Swiss franc Japanese yen pair. Are there any questions about this particular setup before we move forward? I'll give you guys a chance to chime in and or ask any questions. And if you wanted to, you can take a screenshot of this particular image if you want to. It's up to you. You don't have to, but this is something that could potentially happen really, really soon. So let me actually place a red arrow right here to the downside, just in case you guys do decide you may want to, take a screenshot of this. So yeah, all right. So yeah, this is what we have. We're looking for a potential sell opportunity, and yeah, we'll see what happens. If price breaks to the downside, pulls back, then we'll look for a sell, and we have directional momentum in our favor, because as you can see on the daily and on the 4-hour, it showed a bearish environment. So yeah. So yeah, well, yeah, we could probably touch on that later. I was going to share something else, but I don't want to give them too much. But yeah, I know in cases like this, you could have two targets. You could have the first one right above the recent lows right here, where you can just scale some out, just close out part of your position, and then you can keep the rest open until it hits the final target somewhere above here. But yeah, I just kind of wanted to touch on that too. Yeah. So yeah. Yep. So yeah, we shall see. But price could still expand to the upside. So yeah. But in either case, we're definitely in that C leg with the way things look. And we could be seeing a reversal happen really, really soon. Yeah. And just like Melvin said, like price could do many things. You remember, like in trading, we're really assessing and speculating on random outcomes or random movements in price. So based on what we do know right now, pre-market, and with what the futures market is showing, we're seeing a little bit of risk appetite. So then that may be negative for the yen. So we may see the Japanese yen weaken in comparison to the Swiss franc, but you got to keep in mind that with this pair, both the Swiss franc and the Japanese yen are safe haven currencies, which means whenever there's risk appetite, both of them usually sell off. So it's going to be interesting to see how this plays out. But yeah, like one thing, yeah. So then when you do trade technically, you have to take into consideration the micro flows, the market conditions. Does it seem as if the market is very does it seem like they have an appetite for money, for yield? Does it seem as if they're willing to take more riskier positions and go long on equities? So then if that's the pulse or the temperature that you see, then of course you got to look at your technical setup and say, okay, then like this is what I'm seeing technically, and I'm going to prepare for it if I see signs of price breaking and violating certain levels. But I had to also keep in mind that based on what I'm seeing across the broader market, there is risk appetite. So then you just want to make decisions that sort of can protect you and insulate you from heavy losses if you end up being on the wrong side of the market. But yeah, so that's where good decision making comes in. That's where good risk management comes in, where you change your risk depending on each scenario. You change how much you position yourself in each trade based on the what the market gives you, the conditions of the market, the price section of the market. So each trade is going to be different, and that's the thing. Like, one thing I do not like to hear, and I know a lot of people teach it, but they really, some teachers or some programs teach that it's okay to use one standard lot size or one lot size or position size for every single trade you enter. And that's not really good, responsible trading. Like, really, with every single trade you execute, your contract size or position size should be unique to that particular trade alone. Based on the fingerprint of that trade, there should be a unique position size on each trade you enter. You shouldn't enter the same standard or micro lot for each trade. Like it's just something that I've been seeing lately a lot, and it's kind of lets me know it's not really responsible trading, because on some positions you end up losing a lot more than what the trade ideal really you know really set you up for. You end up losing a lot or either gaining above and beyond what. And in those cases, yeah, it looks good, but like you want to be responsible with your risk management and money management. And you have flexible, like, how can I say it, position sizing, where for each trade, the position size is different. You don't use the same contract size. But yeah, one of these days, we're going to probably do maybe a topic or a lesson on it. I know for those of you guys that are, paid members, you have access to those lessons, about money management, position size and lot sizing, lot contract sizes. But yeah, we may do like a webinar to discuss that as well, because that's something that we commonly see across the board. But yeah, yeah. All right, so yeah, it looks like it may want to rotate lower. The way it's pushing down right now, but we don't know yet. And this is affecting our other two trades that we have active right now. We've seen a nice pullback in both of them. So then we're definitely lost some unrealized profit on those two positions based on price looking like it may want to pull back now. So then, yeah, I don't know if you guys are in those positions, but if you want to, you can move your stop to break even on those, and we'll see how things turn out. But yeah, this is the Swiss franc Japanese yen. Are there any questions before we move forward again? Going once, going twice. All right. So I guess with that said, we can move on, and we can talk about one more pair, which I'm not too confident in this one right now. But it was the US dollar Swiss franc. So let's do that right now. US dollar Swiss franc. I believe this one could be shifting and rotating as well, mainly due to what we just saw even on the Swiss franc Japanese yen. So for this one right here, what we see is, price gave us this impulse, and then we see price give us this complex correction. So what we should do right now is definitely look at directional confluence to see what side of the market we need to be on. I think things are shifting now, and we could see price, just like with the Swiss franc, Japanese yen, break to the upside, break this area. Let me be more specific. I would like to see price break this particular zone up here, right around here, this zone, before we decide to do anything with the US dollar Swiss franc. But let's go to the 4-hour and the daily to see the directionality. 4-hour bullish. It looks like we could be in the midst of a 4-hour correction lower before, and now we're looking for the impulse higher. But the daily is also bullish as well. So let's look for an opportunity to trade this pullback lower on this chart right here. So, all right, we see that price pulled back, and where did price pull back to? We'll put it back to this level right here, which is called what? What is this called? What is this level called? It's 1.00000, and there's two names that I will accept for this one, but it's called something. Yep, institutional level. Yep, institutional level. Yep, exactly. An institutional or psychological level, a banking level. However, this is also called parity. 1.000 is parity, which means what? It means, well, I'll let Marvin explain it, because I know some of you guys may not know what this means. But what this means is
I
that
guess you can just ask them, like
yeah. Well, yeah. Let me ask you guys, when we have price on a currency pair at 1.000, at 1.00, what does that technically mean, or what does that mean?
Just fundamentally.
Even fundamentally. Yeah, because I think it's important for you to know that, because remember, when we're trading in currencies, we're trading currency pairs. We're trading one pair against another, or one currency against another currency.
Yeah, and also like these prices on the right, like they're really the exchange rate. So really, it's the rate of how one is valued in comparison to the other. So in this case right here, you have in US dollar Swiss franc that it pretty much reached parity. So then in your mind or in your thinking, what do you think that means? And of course, if none of you guys have an answer, we can definitely. Okay, yeah, I know Jesse said like a 1-to-1, sort of. Yeah, like I know you're going in the right direction. But I guess for the sake of time, I can just kind of clarify it. So then, what parity is? Parity is parity. Parity. It just simply means that both currencies are actually the same value, are at the equal value. There's not one currency that is more valuable or more stronger than the other. Like both of them have equal value. That's what parity is. They're at balance. They have an equal value. So the exchange rate between the two is 1, which means that 1 US dollar is worth 1 Swiss franc. 1 Swiss franc is worth 1 US dollar. So that's what parity means. So then it's a really important thing to keep in mind, like especially when you understand the forex markets, because anything above parity, like let's say with this $1, we know this $1, this white line right here. Right now we see price is above parity. So then what does that mean right now? Price is at 1.001, even though it's not really a lot above it. But then this lets us know that the US dollar is a very, very tiny tidbit, a little bit more stronger than the Swiss franc. But for the most part, it's still within the $1, area. But everything above the parity causes the base currency, which is the US dollar, to be the stronger currency. But whenever price is below parity, right here, below this right line, which we saw right here, this is when the Swiss franc is the stronger, currency. Because, it takes a lot less Swiss franc to purchase one US dollar. So then this is kind of lets you know which currencies are strong or which currencies are stronger than others. So then right now the US dollar has rallied so much that it's become one of the stronger currencies. It's not the strongest currency. Actually, what's been interesting is that the Russian ruble has come out ahead of a lot of the currencies. The Russian ruble and the Chinese yuan are two of the currencies that come from nations that are sort of, how can I put it, at odds, you can say, with US policy, NATO policy. But you can see that those currencies, the Russian ruble and the Chinese yuan, are actually some of the strongest, or if not the strongest currencies for the year thus far. So then that's interesting. But for the most part, the US dollar has been gaining because of the Fed moving forward with their rate hikes. That's been pushing the value of the dollar up. You remember, whenever the Fed raises the interest rate on the dollar, it raises its purchasing power. It increases its ability to purchase more. It increases its value. That's what premium does. So then we can see right now that it's above parity, which means that the US dollar is slightly more stronger than the Swiss franc. So yeah, but yeah, that's just a general 101 Forex 101 lesson. That's it's good to review, but yeah, I'm gonna pass the mic back over to Melvin, and he's gonna continue with this analysis.
Yeah. So yeah, so then we can definitely look for based on what we see right now, price is reacting to this level, this parity level, this institutional level. So then we can prepare for a potential push to the upside. Now, before I go into more detail with this pair, if some of you guys were in that CAD yen and pound yen trade, you can either move your stop to break even or close out right now. Just close out, take whatever profit you can right now. And even though we did lose a lot of profit that we did gain from that move to the upside, um, the market is really shifting now, and we see those pairs selling off.
So then we can close out at no
Yes.
loss.
So yeah, you can just close out with profit right now if you want to, just to play it safe, or you just move your stop to break even and just let the trade play out. So hopefully it could play out in your favor. But yeah. So all right. So right now we're expecting price to potentially push to the upside, and as you guys know, you go to the 1 hour chart. This is what we see right here, and based on what we see on the 1 hour, um, price could still go a little bit deeper to the downside. However, sometimes I'm just trying to see how this three-way pullback is. Let me go to the 30-minute. Okay, yeah, this is the 30-minute chart right here. So then, yeah, this one right here is not as clear as other setups are, but yeah. So for this one, in either case, what we're going to do is we're just going to simply just wait for price to break this zone to the upside, and then wait for a pullback before we go long. The reason why also we want to do this is because we see at the same time price is forming sort of like a descending trend line resistance as well. So we see this descending trend line resistance. We got structure to the left right here. What we need to see is price push up, break this zone, break this trend line, come back to retest this area, and then look for a selling opportunity right around here. And a buying opportunity right around here, and then trade that to the upside. So yeah, that's something that you could do. That's an approach that you can have on US dollar Swiss franc.
Move the arrow.
So yeah, we'll see. We'll see how this goes. Let's do this right here. And all right. So yeah, let's see how this goes. Of course, there's no guarantee that it's going to happen like this. For all we know, price could still continue pushing lower. So we'll just see what happens. But yeah, so yeah, this is the US dollar Swiss franc. It's very similar, or really it's in the opposite direction of the Swiss franc Japanese yen. But I hope you guys understand how and why and when we tend to switch our bias. Um, but yeah, we're gonna go through more setups like this in the near future that have some level of uncertainty with them. But yeah, yeah. Are there any questions about US dollar Swiss franc before we move on? Going once, going twice. All right. So um yeah, I know Jesse asks, is 15 minutes still the trigger time frame? No, not for this one. I mean, it can be if you really want to drill down and wait for more confirmation and get a tighter stop. But no, the 30-minute or the 1 hour is your trigger time frame. What you want to do, because this is a 4-hour pullback. It's a 4-hour pullback type trade. So you just wait for a price to break to the upside, retest, and then you can look to buy. And for this one, you'll be holding out a little bit more. It may take a day or two for price to hit the target. But yeah. So yeah, this is the US dollar Swiss franc. And yeah. So yeah, are there any more questions or no? All right. So what I guess we could do right now, I don't really have too much on my radar right now. What I'm going to do is pass the mic to Marvin, and he's going to talk about what's been happening fundamentally and all that good stuff. And then we may do some top-down analysis. But all right. Yeah. So yeah, I'm gonna briefly, sort of, discuss how things have been this week. As those of you guys that have been trading would know, this week has been a pretty volatile week in the markets, and that's something that you've been hearing a lot. You've been hearing volatility, inflation. So we know that this week, one of the main economic first tier sets of data that many analysts, many traders were looking into, or really trying to see where this particular economic indicator was inflation. All eyes were on U.S. inflation numbers, the CPI and the PPI numbers. So a lot of the choppiness and volatility was around that. And really, whenever you get choppy markets, that's just really an indication of increasing uncertainty, that there's indecision in the market. The market doesn't know which way to sort of lean, whether to allow the bulls to take over or whether or not the bears should. Because right now there's just a series of just multiples and just different things that are kind of leaving investors sort of, I wouldn't say they're sitting on the sideline, but in many cases they're kind of like they're wondering what's going on, because lately we've been seeing disjointed markets. We've been seeing disjointed price action. Our traditional correlations that usually make sense haven't been quite making sense. So, like in times where there is uncertainty about future outcomes and future markets, then we will see the VIX usually respond in a unique way. And really, our VIX is considered the volatility gauge, where it usually serves as a hedge for risk, so that whenever there's fear or there's uncertainty in the market, or whenever there's the possibility of asset prices tumbling lower, you normally see people hedge themselves with the VIX. They'll start buying the VIX as insurance to sort of insulate themselves from any losses that may take place as a result of holding on to risk. So then what I'm going to talk about right now is just volatility in general. We're going to touch on the VIX, but since this week was an interesting week where we saw a lot of whipsaw activity, choppy markets, especially with our stock indices like the S&P 500, the NASDAQ, the Russell, like all of those indices, we will see them move in one direction earlier in the day, and then all of a sudden it reverse midday, and then by the end of the day, it may even flip again and go in a certain direction. So then we had a lot of seesaw, choppy price behavior. But
right now we're going to talk about volatility because that is important, especially since we're going to be moving closer to the summer volatility period where we're going to see a thinning of volume and we're going to see kind of like lower volatility. We just got to kind of get an idea of how much volatility impacts price behavior and impacts the movement of risk assets. Then right now, let me just go to the first one that I have on this chart. There is a volatility indicator that I have, and I know some of you may know it, those that have been with us for some time, but there's one that I have right now on the chart, and that is this one down here at the bottom, our ATR indicator right here. That stands for average true range. So then let me just show you this right here, that as price moves to the upside, we saw a pickup in this in volatility right here, which is really, one of the first lessons I want to share with you, because what has been traditionally taught is that whenever you see a pickup in volatility, volatility is normally inversely correlated with markets. So then when volatility moves up, traditionally we should see risk assets move down. We should see declines in stock markets, because on the way down, as stock markets fall, volatility usually increases because there's a lot of, panic selling, there's risk aversion. And in downward bearish markets, they're a lot more risk sensitive. They have a higher beta, which means that they're sensitive to increment like changes in the price action. They end up sometimes overshooting themselves, like downward trending markets or bear markets. But you can see here how even with the US dollar Swiss franc, even though it's been moving up, we've been seeing this ATR, which is sort of like a measure of volatility, move to the upside as well. And let me just maximize it right here, because you can see that ever since the end of February, even when we saw sort of like the outbreak between the Russian-Ukraine crisis, that was sort of towards the end of February, we saw a pickup in this ATR, in volatility in this ATR, and we began to see it shoot higher to the upside. And, a lot of this is pretty much dollar driven. As we begin to hear more talk of Fed, central bank leaders saying we need higher rate hikes, we need to increase the pace of quantitative tightening, we need to raise interest rates by 75 basis points. That was all done, back in, April or May. But you can see here how it's been pretty parabolic and sharp, this rally or this move to the upside in the ATR. And what the ATR really is just a measure of how many pips on average a particular asset or an instrument moves within a certain time period. So in this case, the ATR is 14, and we're on the daily chart, which means that for the past 14 days, the average range that this particular pair, US dollar Swiss francs, moves in within a 14-day period, the average price or the average range is about 81 pips. On average, it moves 81 pips per day when you consider the previous 14 days of price action. So then that can kind of help you to sort of determine how far you may want to hold out your positions. If you plan on holding a position that you have open, if it's favorable, you can look at the ATR and even other volatility indicators to sort of give you an idea of how much wiggle room you have left for the trade to possibly, play out. Because, you got to look at the ATR is an average, meaning that they take the average or the mean of the past 14 days of price action, which is really like almost, a little bit over 2 weeks. And it can give you a figure to say, okay, on average, US dollar Swiss francs moves 81 pips per day. So with that being said, let me just do this right quick. So this is our daily candlestick right here. Of course we see it's, bearish, but how many pips did it move for this day? So then let's see. Let's go to our price range tool, and we start here, and we're just going to measure from the bottom to the top just to see how much it has moved. So right now, according to what we get in this price range tool, that it's only moved 48 pips, just for today. So that means that if the average trading range is about 81 pips per day, then that means there's a possibility it can move more upside. It can have, move more higher, or it can break more lower. So then what you could do is you can set, okay, some ranges. You could say, okay, then like if it moves 81 pips, then to the upside, it can go all the way up to, let me just do this, all the way up to, $1, 1.008. It can go all the way up to here. And you can set a limit where if you have a position open and it's going so good for you, and let's say you want to keep it open, you can close your trade out somewhere below this particular line right here, based on what the ATR indicator is giving us. But on the flip side, if it continues to slide lower, because we know right now it's moving lower, the current price is below the opening price. So then we can also take it from the highs down to the lows. We know it's like about 40 some pips. So then we can, go all the way down to 81, around there. And then we can just, do the same thing. Let me just clone this, and then we can just say, well, I got to make sure I close out my position somewhere, above this area. And what's interesting, it brings us right to this area of structure right here, where there's a possibility that we may see it close somewhere around this area at the end of the day. But, nothing's guaranteed. We know that we're trading random outcomes. So then, and it doesn't mean that every day it has to be exactly 81, but this is just a ballpark average figure to let you sort of know how much wiggle room you have to work with the trade. So then so you have a series of tools, and one of them is volatility. Volatility can let you know, okay, what direction you should trade in per se, what side of the market you should, but you can't just look at one volatility indicator. You got to look at a whole bunch of them, like a ton of them. So then one of them is ATR. That's just the average true range. And also we have an offsite one that you can look at that we haven't even brought up, or we haven't discussed in the group in a while, and that is Mataf. Let's do that right now. So let's go right now to www.mataf.net right here. And then let's go to, well, let's just do this Forex trading tools. And then we're going to go to Forex volatility, because if you don't have the ATR on your chart, you can go to this tool, and this would give you more detailed intel on volatility, like how much it moves per day on average. Like even for each day of the week, they can tell you that on Tuesdays it moves more than on Mondays. It can tell you a lot. So then this is right here based on 10 weeks. But if you want to do the past, let's say 4 weeks of data, you want to find out how volatility has been, or how much these pairs or these instruments have moved within a 4-week time span. Then you could just
the previous 4 weeks.
Yeah, the previous 4 weeks. Then you could use this tool, and you can go down. So then let's see what what it brings up for US dollar Swiss franc. So for US dollar Swiss franc, it says 82 pips on average per day, which is close to our 81. You remember our 81 is based on 14 trading days. This is based on a little bit more, like 20 trading days. So it may be a little bit more. So what this is saying, that on average, the US dollar Swiss franc moves about 82 pips per day. So if you know that the pair has only moved about 40 some pips, then you have an additional 40 pips left to go. And that can give you wiggle room to work with the trade, or even decide to hold on to a position that you have, because you anticipated going lower. You anticipated moving a little bit deeper. So this is right here, US dollar Swiss franc, but you can break it down even more once you click on it. So then I clicked on US dollar Swiss franc, and you can go up to the chart, and you can see here how they can even tell you for each day volatility per hour, like how many pips or how many points does US dollar Swiss franc move each hour of the day. So since I currently live in the central time zone in the Chicagoland area, this is 7 a.m., the 7 o'clock hour. So you can see here that based on this volatility tool, Mataf, it's saying that around 7 a.m. Central, which is 8 a.m. Eastern, US dollar Swiss franc moves about 38 pips for that hour. So then every time around this time, it moves about 38 pips. So then if you have a trade on, then you can know, okay, then I know in this hour it moves about 38 pips. So then it's only moved about 15 pips. So then there's a possibility I can hold on, or, maybe I should cut it off because it's reached its average trading range for the 7 o'clock hour. That's if the trade did move, and within that hour, it's already moved 38 pips. But yeah, so you have that. So each hour they'll tell you. So then around the 8 a.m. hour or the 9 a.m. Eastern time, you can see that it moves the most. That's when this pair actually moves the furthest or moves the most, and that's 47 pips, on average for the 9 a.m. Eastern hour, 8 a.m. Central. Since I'm in Chicago, it moves 47 pips during the next hour coming up. So then this can kind of help you. This data can really help you in your trading, especially in currencies. Now there's other tools that use, other assets like gold or other, but the indicator I showed you on your chart can also do sort of like an hourly thing, but it doesn't break it apart for each hour of the day. If you want to, you can go you can use the ATR, you can go to the 1 hour chart, and they can tell you, how volatility has been, within the hours, the average volatility. So yeah, this is, just for this session, but yeah, it's not as good as what we see here, with these tools right here. But you can see for this next chart, you can see that for Friday, it only moves about 61 pips. So then this is when you say, okay, then like on Fridays, on average, it moves 61 pips. So maybe I don't want to hold it out to the 81 pips. Maybe it may be wise for me to close it off or close out the trade a little bit earlier. So in this case, like even for our example, let me just minimize this and go back to the chart. We created this range based on 81 pips, but then according to what we see in Mataf, on Fridays, on average, for the past 4 weeks, has only moved about 61 pips. So maybe it may be wise for us to move this in. So then let's move this down to 61 pips right here. And this could be our range of where we want to close out this particular trade. So, we only have about a little bit of, wiggle room left to go in either direction. But yeah, so then this is just how important this tool is. But yeah, if I were you, I would explore it in, your own time. If you have time, just go through each of these currency pairs and just see how much they move, how many pips they move per day. And then you can set and structure your trading plan, a trading strategy around this tool, and know what to do. So then I hope, that was pretty helpful. Let me see if they have a similar tool in commodities, because I know some of you trade gold. So let's see. This is the commodity section. Like they don't, like for this service, they don't have it. No volatility tool for commodities. But yeah, you just got to look around because they're out there. But if they're not, then you have your ATR indicator that can sort of serve as a guidepost to let you know, okay, how far does it move on average per day. But yeah, so yeah, for the sake of time, like I know there's a lot that I can cover because this issue of the VIX and volatility is important. We may start covering the VIX more on next week, since that's an important indicator to look at, especially if you trade options, if you trade stocks. But yeah, so for the sake of time, let's just go over what the market is doing ahead of the Wall Street Open. So then let's go to our FinViz and let's just look at our futures heat map to get an idea of what's happening across futures, markets. Okay, so yeah, so this is pretty much interesting because we can see here that on Friday, the last day of the month, even though this doesn't mean anything, this can easily change by the time the opening bell begins to sound off. But as you can see, we can see these equity indices, these futures equity indices, all trading in positive territory, with the Nasdaq moving the most. It's up almost 2% in the futures market. So that means there's going to be definitely a rotation into more of our tech-based, growth-based assets. But yeah, some of our higher beta, higher yielding assets. So then, this is indicative of risk appetite, especially if we see that even for our foreign futures, Nikkei, Euro stocks, and our DAX, which is, our European, German indexes, we can see that there's that risk appetite and there's that desire to close the week higher. So for some reason for Friday, we're seeing this desire to close the week higher. And that could be due to, like Melvin said earlier, profit taking, since markets were short, since we did see some moves lower in stock markets, then they could be closing or short covering their positions. And that's what we're witnessing now in future markets. We're witnessing this relief rally into the close of the week. Just ahead of the weekend, traders and investors want to close out their short positions ahead of the weekend. They don't want to hold it open and have that be exposed to all of that weekend risk. But you can see here that the VIX right here is starting to slide lower. It's down about 4% right here, which is sort of indicative of the stock rally. Normally we'll see a sell-off in the VIX, or traders won't feel the need to hedge themselves. They want to take on risks. But we see oil, energy assets moving to the upside. We see bond markets selling off, which is indicative of risk appetite. So right now we're seeing this traditional risk appetite come back into the market, where we see bond market sell off. What's interesting is that we're seeing gold continue to sell off as well, and that could primarily be due to rising interest rates, rising yields, because gold, even though gold is a commodity and it does move by the principles or factors of supply and demand, it's been really more so trading like a how can I say it? Almost like a currency or a tradable asset, where it's very sensitive to treasury yield. So whenever yields move to the upside, you'll see that pressure in gold. So then that's just how it's been trading lately. Even though it's traditionally called an inflation hedge and a safe harbor to park your money, in theory, yes, it is, due to its raw intrinsic value and nature of it. But right now, when it comes to a tradable asset, it's being definitely highly influenced by yield markets, by treasury markets. So we see gold selling off. We see platinum positive for today, but only slightly. But what's interesting is that we see copper selling off as well as a base metal. So then, we're seeing a pullback in some of our hard commodities, while some of our softer commodities are trying to hang on. But yeah, we're seeing some neutral, balanced activity and distribution across the commodity sector. It's not as definite and clear. It's more so mixed. So then that's something to keep in mind. But it seems as if markets may want to be a little bit more neutral. They're trying to search for a reason to go long. So then we're seeing that even in our equity future indices, with this risk appetite setting in, and how most of these instruments are actually trading in positive territory for today. So then, yeah, look for opportunities to buy risk. Look for opportunities to buy the more higher yielding asset. So right here, this is our Forex heat map. You can see that the three strongest currencies on the spectrum are the Aussie, the loonie, the Canadian dollar, which we call the loonie, and the Swissy, or the Swiss franc. Those are our three strongest currencies right now for the session, and our three weakest currencies are the euro, the British pound, and the Japanese yen. So the very fact that the Japanese yen is selling off, you remember the yen loves misery. So the very fact that the Japanese yen is selling off, the Forex market could be cluing investors and traders in that right now, for the time being, you should be looking to take on more risk. You should be not risk averse, but you should have some risk appetite. So we'll see what happens when the market's open. Things can change. We have about 30 minutes, a little bit over 30 minutes for the markets to open up. So of course, the conditions can change before then, but for now, it seems as if the market is cluing us in and hinting that they want to close out the week strong. So then, yeah, you want to trade in favor of those micro flows. You want micro flows to support what you believe in on a macro level. And what I mean by micro flows, it just pretty much means like the market sentiment, risk sentiment, because sometimes there's a misaligning between market sentiment and actually the macroeconomic data. But if you have them all come together and agree along with your technicals and what you see on your chart, that can form a good opportunity for you to trade and make some good decent money before the close of the week. But yeah, it seems as if markets are gaining steam, gaining traction. They want to move higher, and we're seeing the same thing in Bitcoin too. Bitcoin is definitely trading as a high beta asset. It's very tightly correlated with the Nasdaq, and since the Nasdaq is moving higher and is one of the stronger winners for futures markets for today, it's not surprising to see Bitcoin regain traction as well and move to the upside. So the strongest in cryptocurrencies is Litecoin, Ripple, and Ethereum. And the weakest is Bitcoin Cash and the US dollar. They're selling off, for today. So yeah, so that's pretty much it. There's not much to go over. Let's go to the economic docket because we do have some data. And right now I'm going to go to Forex Factory. We haven't gone there for a long time. That's a calendar, even though it's not the best calendar, but it is a calendar that sort of narrows down, the reports. But really, the next important report that we have coming up is University of Michigan consumer sentiment, which is definitely, high tier data, and it's expected to come in at 64.1. That is the market consensus. So this is already priced in to the market, a 64.1% reading. Now, what comes out when the data print is released, whether it's above and below this consensus value, that will sort of determine how the dollar will move and how risk assets will move. But that comes out in about an hour from now, and that's going to definitely introduce some volatility because we want to see the impact that inflation has had on consumer behavior, on consumption. And one of the things we want to look at is consumer sentiment measures. Is consumer sentiment high based on this University of Michigan study, this report? Like, is it high? Are we seeing consumption fall? And this would sort of give us an idea, of where consumption behavior is. So then, so previous month was 65.2, and it is dropping, which is sort of realistic when inflation and pricing pressures are in. We want to see it drop somewhat. So then this isn't surprising, but if we get a number that is really, really low, below this forecast, then that's definitely going to serve as a tailwind for the US dollar. Because what that would mean is that inflationary pressures are having an impact on customers or consumers, buying behavior. And we know that consumption is a major part of the GDP. The equation is a major part of growth. So then we may see the Fed say, well, we need to tighten a little bit more to raise the purchasing value of the dollar, but to also fight off inflation and curb inflation so consumer sentiment can pick back up again. So then, so then sometimes people don't, understand, how these reports, impact the currencies and why would a weak consumer sentiment report weaken the dollar, or why would a strong, why would a strong consumer sentiment report a strong one will be supportive of the dollar, but also a weak one could be supportive of the dollar as well. The dollar will win in either case. It could benefit, based on what the Fed would have to do if it does come in weak. So yeah, but yeah, that's pretty much it. There's not really much coming out later on today. I know on this calendar they don't have the Baker Hughes oil rig count. So then that's something that we definitely got to pay attention to see how many oil rigs were counted for the week, how many were working and active this week, because that does play a part in energy inventories. And, that definitely impacts the global economy. So yeah, there's not much. This is a Friday, so you can take it light. There's some profit taking. Usually, we chill on Fridays. We don't really do too much trading. But if you do find an opportunity, you don't want to miss out on it. You want to definitely take it. But if you don't have this site, Forex, this Forex volatility tool, let me just post it in the chat right quick. This link, I'm just gonna post it in so that you guys can have it and go to it yourself. And you can just use that tool and just experiment with it just over the weekend. Just look through this data and just experiment on it and study it. But yeah, that's pretty much it. So yeah, I guess I'm going to turn the mic back over to Melvin, and he's going to continue with the top-down analysis portion of the webinar.
Yeah. All right. So yeah, actually today we're going to do something a little bit different. What I'm going to do for today is strictly look at the Dixie, the US dollar index, to get an idea of what you may want to do on other currency pairs that involve the US dollar. And there's a reason why. Really, this week, like we said before, it's been a very disjointed week. The markets haven't been moving the way they typically move. So some of the things we typically look for, we may not be able to find. But what we could do is look at the Dixie and see what the Dixie is showing us. So then let's just start with the daily chart right here. Since we're here, we can start with the daily. I know the US dollar is sort of like is sort of correlated. US dollar, Swiss franc is sort of correlated to the US dollar. But anyways, let's move on. So right now we're looking at the Dixie, the US dollar index, and we're currently looking at the daily chart. And as you can see, price still continues to make higher highs and higher lows. It keeps climbing higher and higher and higher with no end in sight, it seems. So from here we see impulse correction, and then price corrected higher from the higher high, higher low, and just kept climbing, higher high, higher low, and it made another higher high. So the sentiment is still to the upside, for the US dollar. However, what goes up must come down eventually. And we plan for these trades. We look for opportunities for price to really reverse, strongly, or give us a nice solid correction. And that hasn't happened. It just seems like price keeps pushing higher and higher. The minute you look for things to change, price does the opposite. But if you look at price right now, we're currently testing this 105 area. Let me make this white and change this up a bit. We're currently testing this 105 whole number, institutional number level. And I'm assuming that price is going to find resistance here, but we never know. Mainly due to the fact, let me just this is bring this down and bring this way. But yeah, so we typically expect for price to somehow respond to this particular zone and area, but lately it's just been breaking through areas of resistance. And for now, based on what we see here, we see that price is hitting resistance. Stochastics is still overbought. What you could do is drop down to a smaller time frame to see what is happening on the smaller time frame. So right now we're on the 4-hour chart, and price could be consolidating, or it may start topping or consolidating right at these highs right here. So it could be topping, moving back and forth before we see a break to the downside, or even a break to the upside, because that's the thing that's been happening lately. Price will consolidate at a resistance and then break above that resistance. Like we've seen it quite a number of times with this pair, the US dollar. And we could even see it right here. Like price was at resistance. It was consolidating right here. We were expecting price to break to the downside, but what happened? Price broke to the upside. And the same thing can happen again, especially in an environment where we're seeing interest rates go higher. So what we should do right now is stay on the side of just being bullish the dollar, and I would love for us to get a nice correction, but as you know, the pattern has been constantly moving up, constantly making new highs, higher lows, and you should still be on the side of just buying US dollar for now, unless we see a reversal happen on the 4-hour chart. In other words, we would have to see, let me remove this, we would have to see like a nice double bottom reversal pattern on the 4-hour, or a head and shoulders type pattern on the 4-hour before we start looking for opportunities to sell the dollar. As of now, we still want to stay on the side of buying US dollar, because it doesn't matter if we're approaching a resistance or not. Price tends to break above those resistance levels, and it keeps climbing higher and higher and higher. So that's what we're going to do even for the next week or so, we're going to look for opportunities to continue buying the dollar until we see true reversal on the 4-hour. So we need to see a bearish environment form on the 4-hour. Now, I know some of you guys are saying, well, right here, we've seen a bearish environment, price broke to the downside, but we still had a move to the upside, and that does happen. So, you know, these markets have been kind of tricky lately. So, you know, this is the reason why we use proper risk management, and we don't become too aggressive in this environment. Remember, we're heading to the summer where there's summer doldrums. You know, there's going to be a level of ambiguity with how price is moving, but this is where you need to use good money management. You know, risk smaller. Don't bet your whole house on a position, but, you know, risk small, and just wait for the trade to come to you. Don't chase trades, you know, especially in the season that we're heading right now, because we never know what's down the pipe. You know, you hear all these issues. We got rising interest rates, but we got a supply shortage. We have inflation. All these issues are weighing on the markets, and ain't no telling how price is going to move and how investors are going to interpret the data moving forward. So, you know, we'll see. But I guess that's it for today. I don't have too much to share with you guys. We can keep it, you know, quick and brief for today. But I want to ask you guys a question. Are there any assets, any stocks, any currencies, any commodities that you want us to take a look at? We can take a look at it. We can give you our bias. We can give you our suggestion. But yeah, now's the time to ask whatever question you want in regards to that. So then, yeah, we'll give you guys a few seconds to possibly chime in and see what you guys want to do and all that good stuff. But yeah, we'll give you guys a second. So yeah, this week we didn't really place too many trades this week. In actuality, we didn't, and you know, it was due to what, you know, how the market was moving for the most part. You know, so you know, it is what it is. We didn't place too many trades. That happens. We may be able to make it up the next week. But the one thing you have to learn is that if you don't see it, don't enter it. Don't buy into it. Don't sell into it. If you don't see the setup, don't move at all.
Yeah. You don't have to feel pressured or forced to trade every single day. Like, you know, that's what it means to be a disciplined trader. Like you only trade when the setup is right and when it's perfect for you. You know, you don't pull the trigger just, you know, just on a whim, just because you want to trade. You know, and that's important for you to know, because some people feel like as a day trader, they have to place a single trade. They have to every single day, but you don't have to. You can pretty much wait till your setup forms and then jump into the market when all the conditions match and meet for your trading strategy. But yeah.
All right, Rod is looking at silver. Silver broke down through that support at 2150. How low do you see the next major support? 18. Okay, so yeah, let's go to silver right now. Let me well, are you looking at it from the 1 hour daily time frame? Let me ask that question, Rod. Which time frame are you looking at?
Daily.
Okay, daily. Okay, great. So yeah, let's go to the daily chart and let's do silver, XG, USD, and you can stick with Orlando. All right. Okay, so right now we're looking at silver, and we're currently on the daily time frame. As you can see, it's a bearish environment. This commodity has been selling lately.
It sounds like a measured move too.
But yeah, it's sort of like a measured move. If you take this move right here, more like a 236 measure move. Let me see. And let me do it from here. I'll do from here to here for the sake of. Yep, but yeah, right about right there. So yeah, it's right here at this area. Let's see if there's any support to the left. I don't see anything to the left. Let me go up to the weekly. I don't see anything on the weekly, but we do have, based on what we see on the weekly, we have support right around here in this particular area right here. Let's draw out this particular zone right here. Let's do that. Right around here. So based on what we see right here, there's a possibility we could see price slide and push all the way down into this area right here. However, let's see. Let me see how this is looking up here. This movement, this consolidation, because sometimes. Okay, let's see something. Let me do this. I want to do this measure move right here to here, and bring this up to the top right here. That takes us right to almost where the 20. Yeah, almost where the 20 level is, flat level is, if we're going to expect a measure move to the downside. So then what we did, we just took this leg right here, this leg, and we projected it at the highs. And there's a possibility that price could find some demand, right in this particular area, right here. So, that's something for us to definitely take a look at. Let me change the color and make this green. But yeah, this is an area where price can go to, maybe around the 20, the flat number, the 20 institutional level, 20.00000. I could see price going down to that level. But if you look left structurally, the next major level is around the 1800s, 18, but it starts at 18.95, goes down to 18.3. But yeah, around 18, that's the next level after this one. So yeah, price could bounce on either of these levels. So then you have to be prepared for what happens on this sell-off on silver.
So then we can probably type the range, and just put it in the chat, form. Like, I don't know if you can see the numbers.
Yeah. Yeah, I know Rob said, will you take a short position now for a swing to those levels?
Not now.
Yeah, not now. Since this is the daily, like, we missed out on our opportunity. It would have been a 4-hour pullback. We missed out on it. If you were to go down to your 4-hour, right here on this pullback, which was a really shallow pullback, but we can see that price continued sliding to the downside. So if you want to, you can. Let me just say that. If you want to, you can. Just make sure you place your stop behind this swing high right here. So, like, if you do enter a short, place your stop behind this swing high, right here, and you can just,
but it won't give you enough.
Ride it down to this zone right here, maybe this level.
Asymmetrical.
Yeah. But if you want to, you can expand it out. It's all up to you as far as your style of trading and what you want to do. But if you want to, you can also move your stop in. You can move your stop in and just put it at the wick right here, which is still somewhat risky. You only get a 1-to-1 reward to risk, but you get something out of it.
Yeah. And I was just gonna say, sort of like that's the consequence of missing your entry, because just like Never said, we were late, on this. Like, if you were talking about swinging this silver trade lower, then if you go in late, a part of sort of like the consequence of that, or just the side effect, or what you had to deal with, is you had to deal with asymmetrical reward to risk. So that's the only unfortunate thing. But yeah, it could still work. Like, if you enter, you set your stop right at the wick, and then you hold it until it gets to these levels right here. Then that can be a swing position that you hold over the next few days, and it could work for you.
Yeah. But looking at this, how would we have entered this trade if we was on this pullback, or if we were in front of this? Well, for here, we'll go down to the 30-minute. Let's see how things look on the 30-minute. And on the 30-minute, you can see the 3-wave pullback. We have leg A, leg B, and leg C. And what you will look for is for price to break below this area right here, this congestion area right here, and wait for the pullback and retest. So that's exactly what happened. Price broke and closed below this level on this candle. Right when it pulled back, that's when we would have looked to enter our sell, right around here. And we would have rode this to the downside.
Mm-hmm.
So yeah, and of course, let me just go with, okay, I'm just going to do a see where the target would be based on this measure move. Let me just I'll go right here to play it safe. So let me drag this right here. Okay. Yeah, there's a possibility we could see price pause, maybe, right around here. You can just put a line there. Right around there is where price could potentially pause. So yeah, but yeah, if you do decide to get it, then it's somewhat risky. Just maybe protect your stops. If you wanted to, you can move it behind this wick of this candle right here. The next following candle right here, move it behind this wick, and that can give you a better reward to risk ratio. But yeah, in either case, we miss out on the entry initially, and sometimes that's you know that's the consequence of not being in front of it at that time. So sometimes you just have to shake the dust off your feet and move on to the next opportunity. But yeah, I'm expecting this to continue falling lower. All right. All right. So yeah, are there any more questions before we move forward? Going once, going twice. I know we're still in the pound yen and CAD yen trades for those who do know. Pound yen snapback pretty strong. That pair is reversing right now, but we can at least get out at break even. CAD yen pulled back as well quite nicely. So we'll see what happens. But yeah. All right. So yeah, until we meet again, you guys have a wonderful weekend, and we'll definitely see you guys on Monday. If you guys don't hear from us over the weekend, we'll definitely touch base with you on Monday. But have a wonderful rest of your day. Stay encouraged, stay blessed, and remember to always count your blessings, not your pips. And we'll definitely see you guys soon. God bless you all. And yeah, we'll see you guys on Monday. And we'll be in a group as well, participating. So if you guys have any questions, we can definitely answer those questions within the main chat. But all right, have a wonderful weekend. Talk to you guys later. All right, bye.